What the fintechs market and talk about is experience and value. It's what do I get from this? Forget that there's an account.
How would you approach typically marketing financial products?
Yeah, Vlad, there's a problem that financial brand marketers have to overcome. And you just kind of hinted at the problem when you said marketing financial products. This is my personal view. I think if you look at what fintech has brought to the table, a lot of the fintech companies, especially like challenger banks like Chime and Varo and so forth, they don't talk about products. Because to a bank, a product is a checking account, a savings account. They're very stuck in the mentality that there's an account and that's their product. And we have to market the product. What the fintechs market and talk about is experience and value. It's what do I get from this? Forget that there's an account. And I associate this a lot with Chime in particular, and I call it, and I'm sure there's probably a better word for it, but for lack of a better word, featureization. Chime talks about early access to your direct deposit. They talk about spot me, money that will get you over the overdraft charge. They've
Right.
got a credit builder credit card. They're not marketing products. They're marketing the experience. They're marketing the value they provide. The account or the product is just this mechanism, this construct we have to have in the industry in order to deliver something. But the traditional financial brand marketers and many of the large banks are stuck in this mentality of marketing products versus marketing service, the service, the value that's provided by the mechanism we call the product. And so, what's happened too is we've kind of even jumped the gun from that. The auto industry has done the same thing. Have you seen any car commercials in the past couple of years? They don't talk about the features of the car anymore. It's, we have global impact on,
Right.
on this, or Subaru, all about the dogs. Well, there's nothing to do with the car. And in financial services, we've kind of almost gotten the same way. It's about achieving your financial dreams with a checking account. Seriously? Or savings account with a 0.005 interest rate, and you're going to achieve
Right.
your dreams. Meanwhile, what's come along are companies like Acorns and Digit and Capital, who provide tools to automate savings and figure out how much more could you be saving based on your spending behavior and income. And by the way, don't worry about it. We can figure it out. We'll take that money, we'll put it right into a savings account for you. And so while the banks are still advertising, hey, you can get a 0.1% interest rate on a savings account, which is 10 times better than what our competition's offering, you got new fintechs coming out going, don't worry about the rate you're getting. You need to be worried about how much you're actually saving, because we can help you do a whole lot more. So it's a very different kind of attitude. And I think this is the hurdle that many financial brand marketers have to get over. But again, Vlad, let's go back to what's the root cause of the problem. The root cause of the problem is the organizational design that says, hey, we're going to budget X amount of our marketing dollars to checking accounts, and X amount of our marketing dollars to savings account, and X amount to our credit card and to our wealth management group, and then you guys go off and hawk that stuff. So it's the organizational system that has kind of gelled this view of marketing the products. Fintechs come along, they don't have that baggage, and they go, well, who cares about what the product is? We're just going to push with the value that we're providing. We'll push the service that we provide. And I don't mean customer service in terms of, call. I mean the service of the service
Right.
delivery of the product or service that they're providing. And I think that's the big challenge that many traditional brand marketers have to overcome here.
Do you see that mentality is changing among the marketing teams at financial institutions and how they approach marketing?
No, I don't think so at all. I don't think they've gotten there yet. I think they've gotten past the let's push, the checking account thing to this more touchy feely, let's, we help you achieve your financial dreams kinds of a thing. And to, some extent, they have kind of started marketing, more digital related things, in terms of, hey, mobile banking, they're stuck, Glad, in this view that it's all about convenience, and it is about convenience. The problem is that, for lack of a better argument, there's general parity in the industry, especially among large banks, regarding the amount of convenience that they provide. So where do you go to differentiate? Well, you have to go somewhere else, and that's why like a Chime comes along and says, well, yeah, their mobile banking capability provides just as much convenience as anybody else's, and so then they go to product features like the early access to Paycheck and things like SpotMe, and that's why they do so much better than even some of their fintech competitors like Varo and so forth. It's a challenge for a lot of the big bank marketers because, the other thing that's kind of coming along here and changing the world, and I just wrote about this week, are these what I think of as personalized banks. And it's not the one-to-one notion marketing, it's the segment based. You've got banks here like First Boulevard that serve Black American consumers, Purple that serves disabled consumers, Pad Bank that focuses on truckers, Panacea Financial that serves young physicians. What they've uncovered, Vlad, is that there are unique needs of various segments. Good example of this is a company called Daylight that provides banking services for LGBTQ consumers. Now, to a large percentage of the population who are not LGBTQ, they look at that and go, what do they need? How would they be different? They don't understand that. And the marketers in big banks don't understand. There are unique needs. I had a buddy of mine uh, who fits into this category recently said, my partner and I went into a bank to open an account. And when the form says, has to be jointly signed by husband and wife, what does that tell that consumer about what that bank provides? So, this is what's kind of emerging is that there are unique needs. You would never think maybe that there were unique financial needs of young physicians. However, think about what they've gone through. They spent 8 years in school, not making a lot of money. They get out, they're in residency, again, not making great money, but they have huge amount of student loans. So their debt to income ratios are horrible. Then they get into an early practice, they start making more money and start making good money. But they go for a loan. In fact, I was talking to one of the co-founders of Panacea, and he said that, when he started his early practice, he went to a bunch of banks to refinance his student loans. He said, not only did they offer me a rate worse than I already had, but they wanted me to have my parents co-sign the loan. So I'm 30 years old, I'm making decent money, but because my debt to income ratio was so poor and because my credit history wasn't there. So we are in this world where there are these unique needs, and pre-digital channel, pre-internet, pre-mobile, smartphones, it wasn't economically feasible to serve narrow niches like that because they were geographically dispersed, and the just numbers just weren't there. To become a national brand, you have to spend a lot of money. You still do, to really build a national brand. But if you're going after a smaller niche, you can be more geographically diverse these days and leverage the advantage of the digital channels to find those needles in the haystack that you're looking for without having to build branches all over the country and advertise all over the country like you used to have to do. So the big banks really struggle with this, Vlad, because there are so many underserved niches. I mentioned a few. There's environmental consumers that are being served by companies like Aspiration, and you can find a lot more examples of this. But it becomes a burden for large banks to have to establish groups who are going to focus on and establish the needs of smaller segments of the market and deliver personalized, customized solutions, products, and services for those groups. And so, the big banks are going to find that these new companies are going to chip away at their customer base for the next 5 to 6 years.
And I think you mentioned something very important is that it's personalized solutions, right? Not personalized marketing messages that are pushed to you to buy a product that's not personalized for you.
That is spot on. It's funny you mentioned that too, because that was a key part of the article I published in my Forbes blog, that it's just not personalized solutions, but that is very important. But the idea is it's not just messages either. It's about conversations. It's difficult to truly have a personalized conversation with somebody you don't know. But what happens is the banks are so focused on personalizing messages. But what happens when the customer or prospect actually responds to your message? All capabilities of personalization go out the window. But if you're daylight and you're focusing on LGBT consumers, well, again, yeah, you don't know that exact person. But because there is this, they are part of this group, and we know what the general unique needs and issues and problems and desires of this unique segment are, it makes it more easy to have that conversation and know that you're probably dealing, even though you can't do it individually.